So where do we go from here, and what should investors be doing now, considering that we've seen a big rebound from the lowest levels in this war? Well, we have with us George Heber Joseph joining in, who's Chief Investment Officer and Chief Executive Officer Equity at ASK Investment Managers. Thanks so much for being with us, George. Great to have you on the show. Pleasure to welcome you on Moneycontrol. So, it's been good tidings for investors. At least the last 5-6 trading sessions have brought back a lot of... Thank you so much. So, good tidings for investors, a solid rebound over the last couple of weeks. What have you made of the fall and the pullback? A lot of people said that this is not going to be a V-shaped recovery. Don't expect a quick COVID-like, snap back. But, well, now the markets are showing momentum again. So what's your reading of the fall and the recovery so far?
The fall has been specifically with regard to the fear on, everyone, the world knew about the Strait of Hormuz, right? So it was like a massive fear which set in because of the war situation. That was the main reason why markets corrected. And secondly, when I look back, in the last 12 months, 12 months back, what was the situation? The valuations were still very steep in the mid cap and small cap space in general. And FIs have been significant sellers in the large caps because that's where they can pull out money from. And also the bond yields were inching up globally. So all put together, it was a very tough situation and, very bleak environment. And especially when a war happens, people all worry about their investments in Middle East and so on and so forth. It was creating a lot of chaos in the minds of people. So the behaviors will change. That's our view. Say for example, the people who are going into Middle East or especially Dubai real estate today, now people might take a pause and think that, okay, India real estate is better. Or should we rethink on those decisions? So there will be a behavioral change of this war-led situation is what we believe. And many stocks in the large caps also, because of various reasons. First of all, FI is selling, as well as, you saw a big round of negative news flows on some of the large names which came up because of the chairman resignation and so on and so forth. There was various news flows which already took the stocks down, and which was already cheap became more cheaper, and therefore our house view is that Nifty 50 as a basket looks extremely attractive, and there is a room for the PE re-rating to happen because it is trading at 17 times earnings, and if the earnings rebound over a period of time, obviously next 1 or 2 quarters, the energy challenges will be there. But at the same time, the structure of the Indian economy still remains intact, and we will see there is room for the PE expansion, the Nifty 50 basket. And where the pain has been massive, what we believe is in the micro cap segment. And mid and small cap, still the mutual fund flows were holding up. Therefore, it didn't crash the way ideally it should crash. What we have seen in 2008 fall, 2020 fall, the small and mid caps had the maximum pain, which we didn't see in this fall. But we think that the micro cap segment looks extremely attractive. So Nifty 50 and micro cap, these are the 2 pockets, which I feel like, thumping the table buys.
Wow, so that's the 2 extreme ends of the spectrum, right? Large caps on one side, and then you're seeing interesting opportunities in micro caps as well. So, yeah, okay, large caps, one completely understands there's been so much correction, constant FPI selling, so your argument on valuations is well taken. But micro caps, George, expand on that. What kind of stocks, what kind of sectors, themes?
Yeah, so if you look at the microcap segment in general, they are all, some of them have very few clientele. And secondly, they are exposed to one geography, and various other client concentration is a problem there, and which is the case with the small cap and micro caps in general. But the flow of money also has been phenomenal in these days towards the mid caps and small cap segment, especially because of the mutual fund SIP flows coming in. And therefore, the mid and small cap didn't see much carnage. And whenever we see that there is a macro headwind, or you see there is a policy headwind, you see the sudden impact happens in the companies, in the smaller companies. And especially this time around, I can see in the micro cap segment, there is a massive carnage in many companies and sectors. For example, construction companies, they have gone out of the window and radar, as well as the companies, most of them are in the micro cap segment. If you leave aside few large cap construction companies, maybe government oriented or government companies or a few companies, you can see majority of the micro cap stocks in mainly the construction companies in the micro cap. Or if you look at the data center, people talk about the data center as a theme. There's a good case to look at some of the micro cap stocks which are exposed to, be it optical fiber cables and so on and so forth, is more towards the data center theme, which you can pick and choose from that. Or say, for example, even in the consumer durable space, there are various companies which have been beaten out, and it is available at a ridiculously cheap valuation. And because the parent selling, or it could be various reasons, those stocks are where it is. At some point, and these stocks used to trade at 5 times sales and 6 times sales. Right now, it is available at 1 time sales and 1 time book. So to me, some of the
So when you
consumer
say
discretionary
durables,
names which have been beaten down to dust, or yeah.
so so George, just trying to understand, when you were saying consumer durables, do you mean sort of like the AC companies or electronics?
Yeah, so AC companies and say for example like say we have a good summer this time, and there is a talk around El Nino and things like that. So if you look at there are companies which are only exposed to fan segment, right? And which is like down,
Yeah,
70%, 75%. So you have various companies in that space. You can pick and choose in the micro cap and small cap space. So
sure.
you have to look into the details, but it's
Sure.
a clear stock pickers market, in the small cap and micro cap, otherwise you cannot make money. But where the pain is high and, the things can normalize, that's where, we see there is an opportunity clearly there. And especially the Nifty 50 companies, the
Yeah.
large companies, because of probably the scare of anthropic, or, scare of war, and, and also the FIS selling, there is a huge price value gap which is in the Nifty 50 stocks as well.
So coming to Nifty 50, and I'm looking at your March fact sheet. In terms of some of the top holdings, you have a lot of financials in the portfolio. There's Kotak Mahindra Bank, I can see there's SBI, there's HDFC Bank, Bajaj Finserv, and Geo Financial Services. So clearly you like financial services quite a bit. But incrementally, I mean, because a lot of these stocks have rallied as well, right? In the last 2 weeks from the trough, they've rallied quite smartly. Incrementally going forward, what is what's the pecking order for financial services? Private banks, PSU banks, capital market stocks, NBFCs. How would you divide it?
So we like the entire space, and when I joined ASK almost a year back, what we were looking at is the financial services space, especially the lending institutions, were trading at two standard deviation below the mean. So it was one of the cyclical sectors which was looking very, very attractive. Mind you, so for example, 10 to 20 was a cycle where consumer-facing businesses or distribution-led businesses did very well. Post that, the inflation kicked off, and you saw the global inflation, interest rates moving up, and the entire inflationary protection led sectors did very well. That's where real estate, engineering, capital goods, and PSU banks and all these did very well, because PSU banks are exposed to these sectors which did very well, be it commodities or be it in engineering and utility sector. So we saw that the NPAs are declining in the PSU space. So we were quite comfortable with the PSU banks per se. And also when we look at from the private banks, some of the large private banks were not performing mainly because of maybe institution problem, their CD ratios went up significantly, and also you saw the credit growth system was very bleak. Now, if you see the latest credit growth number, it is around 16%. So it is a marked change we can see from, a year back where the credit growth was, and today it is at 14 to 16% range. It has been moving around in the last few fortnights, and that is a clear a situation where the private banks actually do very well. And we have seen some of the names which you mentioned in our investments, which we are invested for our clients. Those companies, even though it has not done well for last 5 years, it is available at a very, very attractive valuation. And also we see the credit growth in the system picking up, which is a very conducive environment for these companies to do well. So we are seeing large, mid, small, all kind of lending institutions will do well. And especially in a scenario, what we are seeing, the energy prices are high, the working capital will get elongated, and therefore the demand for money will increase. Therefore, there is a very interesting situation at which these things are positioned. So, lending institutions we like the most because the valuations are more cheaper there, and especially large ones. Mid-sized ones has already rallied in the last 10 months. And we see the capital marketplace, many of them are fully valued, and therefore we are less positioned there. Lending institutions the first priority, followed by NBFCs, because NBFCs demand also will increase. So we are seeing a good growth environment, the credit growth environment picking in across sectors, and which will be beneficial for these institutions.
Sure. George, what I find interesting, and again, I'm looking at your fact sheet, is that I think you're underweight on power and on metals and minings compared to, how these indices are placed in, how these sectors are placed in the respective indices. Why is that? And that seems to be a bit of an anti-consensus call, because most people we hear in the market are very optimistic on power. Power stocks started doing really well as well in the rebound. And likewise, metals and minings. I mean, it's been such a commodity boom in the last couple of months, right?
Yeah, commodities have been doing very well in the last 5, 6 years. If you see, commodity index has become 6x in the last 5 years, right? And also, power sector stocks also has moved up by 4 times in the last 5 years. So there is a massive run these stocks had in the last 5 years. And ultimately, if you remember, especially with regard to commodities, we are a little bit sanguine to the fact that we need to buy good businesses. The philosophy of ASK has been that buy good quality growth oriented companies in our portfolio for our clients, which does a lot of value addition to the business, and buy in terms of providing new services or new products or new so that is not fitting well with the commodity basket per se. Steel is a steel, or zinc is a zinc, after all. And we understood that the inflation environment, commodities do very well. But nevertheless, we look at commodity proxies to a certain extent, be it chemicals or, where we can make money through the value addition mindset and quality mindset. Secondly, in terms of power, the question which you're asking, we are positive on the power sector segment, but what we realize is that after the sudden fall in the market, these are all fixed ROE businesses, right? 15% ROE, these companies, if it is a government company, and where based on their investments, they don't make beyond that. So, there is a limit to which, these companies' valuations can expand. So in a scenario like this, where actually the power sector will be at a center of attraction in terms of the AI and so on and so forth, the sector will do well. But we think that from the price value gap, there are many other stocks to pick and choose. That's why we are not invested in that.
Okay. All right, George, we'll leave it on that note for today. Thank you very much for joining in. Good to get that perspective from you on the market and the pockets you like and the ones that you are avoiding. Good conversation, and we look forward to more of these in the months ahead. Thank you very much.
Thank you. Thank you so much.
Okay, so with that, let's just do a quick check on the market once again. The Nifty